Hey, this is Sasha, the options coach. In today's video, we're going to take a look at stop versus stop limit orders. It might sound basic for some people, but it is kind of important to understand if you like using stops. Now, depending on what strategy you're using, like some option trading strategies, you may decide I don't need stops. And you might say, well, how is that? Well, it depends on the strategy and structure. Certain risks are already built in. As far as the max loss goes, so you might not need them. But in either case, I'm going to show you at least the difference between these kind of two orders, because there's a question here that I saw on Facebook that I think could be beneficial to some other people, because some people don't know, and that's totally okay, because I've coached people anywhere from beginning all the way to more advanced financial managers, planners, hedge fund managers, you name it. I've dealt with it, and just want to share with you some insight. Usually on YouTube, we do a little bit more basic things. So here it is. What's the difference between a stop and a stop limit order? So when we look at these things, they kind of apply in two different scenarios. Really, the point of the stop is, hey, when this price point hits, I need to get out. And that's what the difference is, or the core, at least for these order types. So when we look at, I've got 5 shares here of Apple, again, in a simulated account, just as a general example. So there is my quantity of 5 shares, and I purchased that at $214.92. So I am down about 23 bucks. So let's say this thing is going against me, and I want to go and close these shares. So what I can do is, if I go down to the bottom, and I'll go in and create a closing order. So I could sell the 5 shares right now and just get out of it. But what I could do is say, you know what? I could take some heat. I can switch the limit order to a stop order. So what this will do is specifically trigger a certain stop. So the current price of the stock is 210.27. So what I could do is say at 210.20, get me out at market order. That means, hey, at 210.20, if it hits that or below, it will get me out at whatever price it is. So 210, maybe even 05 or 210.11. It might get me out below this level. So even though I triggered my stop here, but remember, if the market is crashing, moving down, that kind of thing, this is where those market orders might be handy. So I'm in it, and then once this price hits, it just get me out as a market order. Now that's kind of one way of doing the stop. The second way is a stop limit order. Here, what we're doing is the same principle. Hey, this is my stop, but I want at least, and you could write this in at least like $210.05 or something along those lines. So you could go in and specify the exact price at the minimum where you're willing to sell the stock. Now, remember, if you do a market order, like on a regular stop here, it's going to get you out. You have a higher chance of getting out. Like, I'll just say 99% of the time, you'll get out fine. If you do a stop limit order, you may or may not get out if you're not at the computer screen. And that is because if it blows through this price or it goes the other way and vice versa, it may not actually get filled. So when you're doing this limit order to sell, you may want to give a little bit of a cushion, like 209, let's say, I don't know, 19, for example. You could give it a little more room. You could also give it a little room of like, hey, I'll sell it at even 206. If it blew through my stop at 210, I'll make sure I have a good range just in case it's crashing a little faster, so I can get out. Now, it'll often get you out at a better price anyway. But the point being is, at least you've got more wiggle room, but at least it won't get you out at like $96 or something like that. So it's a little bit of a, call it a safety net to have a limit in place, even if, you've got a wider limit on that. But that's when you would kind of use these concepts. So anyway, so if we go back to kind of like a stop on here, and we go now to a market order. So there's your stop, and I could say, hey, there's my stop at this spot, and then just get me out at market order. So if that trigger hits, what you'll see is then I will get out in that spot. So it's waiting for the stop, and then once it hits that spot, then it'll push me at a market order. So that's what it does. That's the way that it works and behaves, and the way that it functions. Ultimately, this is good for if you're, there it is, stop, filled, boom. It hit it, it triggered it, and then it got me out as a market order. So with the liquid stocks, it's usually fine. The issue is with the illiquid stocks, this could be a problem. But there we go. The stop got hit, and then we got out, and we got out nicely, you could say. Now, the limit order, you could at least specify and be more specific at what price you want to get out. Anyway, I hope that was helpful. Truly appreciate you joining me. If you're interested in some more videos and trainings, definitely check out the website. There's a lot of great PDF worksheets, cheat sheets, free trainings, guides, those kinds of things. Just check it out on our website there down below. And you could check out the trading bucket strategy that I've got as well. Some good training and worksheets there on that as well. Anyways, thanks for joining me. Maybe I'll see you in one of my coaching groups, maybe one-on-one. We'll speak together. So feel free, reach out, and I'll see you next time. Take care. Bye-bye.